Hey, how's it going, everybody? Mike Weber here, your Los Angeles and South Bay real estate broker, here with your real estate market update for the beginning of October 2021. So, a lot of crazy things happening in the real estate market right now. Several things to talk about that have really kind of happened or changed, somewhat since we did the last market update video. One big thing that's happened in California, anyways, is the passage of Senate Bill 9 and Senate Bill 10 that Gavin Newsom recently signed into law that are going to basically allow a lot more housing development in California going into the future. So SB 9 is going to allow certain lots that were previously zoned as only one unit or one single family home to have the potential to be divided into two lots, in which case there can be a home and then an ADU on each of those lots for a total of 4 properties where one currently exists. Of course, there are going to be requirements and qualifications, and a lot of things are going to need to happen probably for cities to start allowing this stuff to take place. But certainly it passed, and it looks like it is going to be in the pipeline. SB 10 allows for properties where there could only be one home in the past and an ADU to have the ability to now have up to 10 units, assuming it's in an urban zone and meets other criteria and requirements. So this could certainly increase density substantially and create a lot of opportunity for investment and development in what used to be single family neighborhoods. So we'll have to see how this plays out. The current data says that it's really not forecasted to create that many new homes as one might expect, meaning there's going to be pretty stringent requirements on the areas that this is allowed and what's allowed to happen with these lots and all this kind of stuff that's ultimately going to limit a lot of potential development. But at least to me, it seems there's going to be a fair bit over the next 3, 5, 10 years of new development, new density that are going to be coming on the map in California as a result of the passage of these 2 Senate bills. Now, another thing that we're seeing is just a ramping up of the continued government support and propping up of the housing market. So as I've talked about in previous videos, one of the things that the government is working on is a program to give first-time buyers a tax credit as high as up to $25,000. I understand it, to encourage them to go out there and buy new homes. Now, I heard of another recent program, I think it might be tied up in this infrastructure bill, I'm not sure, is to give first-generation home buyers a subsidized loan on a 20-year time period that's going to have a much lower rate than the general rate prevailing in the market is going to be. So all these things that the government are doing constantly to try to artificially prop up the housing market that's already super high as a result of this long period of ultra low interest rates. And instead of allowing any adjustments to take place and prices to, adjust to where demand actually would be if all of this money wasn't created and printed and doled out to prop the market up, is something that they're just not going to allow to happen. As I suspected a year and a half ago, when a lot of other people were saying they were expecting the housing market to crash last year, then they were saying this year. And of course, we haven't seen anything close to that. In fact, for the most part, we've seen a huge run up in housing prices. Although that run up is starting to lose some steam now, there's absolutely no inventory at all to speak of. And there's certainly still healthy demand out there for whatever properties are being listed. Next, the federal eviction moratorium finally ended. And just when landlords thought they were going to have a little bit of help in being able to get some of these non-paying tenants out of their property, the city of Los Angeles came in and extended their own moratorium for, I believe, as long as a year. The county of Los Angeles also came in and created their own sort of moratorium or rules. And several cities in the county of Los Angeles are also doing the same thing. So there's a lot of uncertainty now as to whether a landlord's going to be able to evict certain tenants that haven't been paying for a long time since COVID started. I've been hearing a lot of preliminary reports of landlords not being able to access any of this funding that's supposed to exist to help them for the tenants that they've had that haven't paid for a long period of time. So just when everybody thought that these landlords are going to be able to gain control back of some of these properties, and maybe that would increase some of the supply of housing and multi-unit properties on the market, it doesn't look like it's going to play out that way as I expected. And of course, now this could be, another 6 months, another year, and who knows, this could just perpetuate on into the future. So we're going to have to keep an eye on it. It seems in some cities there may be some opportunity at this point, but it's unclear and it's changing rapidly. Finally, the last thing that I wanted to talk about that's really limiting the supply of homes on the market and creating more artificial demand is we're seeing a ton of growth in public companies purchasing single family homes, either to turn around and resell or to keep long term as an investment. And these companies, it's important to realize, have access to debt at far lower interest rates than the average consumer or purchaser of a home have. So they're issuing, billions, tens of billions of dollars of debt at, a fraction of a percent. They're able to issue stock in these public companies to generate money, capital, so that way they could go out there in the market and either buy up the assets that are available to turn them into long-term cash-producing rentals, obviously with a cost structure that's far lower than what the average investor would face if they had to buy these assets and rent them out. So now, not just are home buyers facing competition from big public companies that are buying up a lot of the inventory, but also mom and pop investors are going to be in a position where it's even harder for them to compete, unless of course they have a significant value add strategy to be able to squeeze more revenue out of these properties to make them actually make sense, even with these ultra low interest rates, because prices are so high. So this is an ongoing thing. I think this is going to just speed up and increase as time goes on. There's going to be more competition in this space, not just from the Zillows and the Open Doors who are ultimately trying to come in and buy these houses a little bit cheaper than market just to turn around and resell them at market or above market, but also companies like BlackRock that have a long-term strategy that just want to buy up, tens or hundreds of thousands of units and keep them for the long term as rentals that they can manage with a very low cost structure. So let's go ahead and jump into the data and see what's actually happening with median home prices, closed sales, and the supply of inventory, both in Los Angeles County as a whole and in the South Bay beach cities. All right, so let's get started here in the county of Los Angeles. And what we see is that median home prices are only up 10.5% year over year. Now, of course, it's pretty funny that I'm saying only because that's a massive increase. But compared to what we were seeing there for a while, this is certainly much more modest. And so what's happening is that median prices are kind of trending downward, as would be fairly typical heading into the holiday season. So it's interesting. It's hard to say, have we kind of broke this trend of just incredible, massive price growth, or is this just kind of a blip, and then we're going to see another acceleration start picking up again, after the holidays or in the near future. We'll have to keep an eye on it, but definitely that insane growth that we were seeing for a while is starting to taper off and slow down, which will be, happy news for buyers, of course, that want to try to get into the market before they're priced out completely. Now, if we look at closed sales are really strong. Obviously, anything that's getting listed, if it's priced correctly, it is selling quickly. So we are still seeing relatively strong closed sales across the board. And if we compare that to the supply of inventory on the market, there's where we see how closed sales are so strong, because the supply of inventory sitting on the market at any given time this year has been just dramatically low. So we're down 36% compared to where we were a year ago. And there was already, as you can see here, a declining level of inventory all last year. And now this year, we've just been far below that amount. So what that means is that sales are still taking place. People are still buying. It's just that there's very little that's available to look at or to try to purchase at any given time. And whatever is getting listed is being bought up very quickly by buyers out there in the marketplace. If we take a look at the South Bay beach cities, we see kind of a similar trend. Median prices now are only up 5.2% year over year. So for a while there, I was giving numbers, above 20%. And now things have really tapered off pretty substantially. And now we're down to just over 5% year over year, which really isn't, all that excessive compared to some of the previous years that we've seen. And it's starting to look like this might start to kind of go on for a while. So, we'll have to keep a close eye on it. Now, one thing to take note of is that if prices are slowing down and decelerating, even with almost no inventory on the market, what that really means is that there's less and less buyers that are willing to purchase these properties at these higher price points. And so that's definitely something to keep an eye on, because the amount of demand is starting to wane, it seems, although there still is enough people that are willing to buy at the higher prices to sustain price growth. But it's not the same as it was before. Instead of 10 or 15 offers on a property, maybe it gets 2 or 3 offers. And if that continues to wane, for a lot of these properties, there may not be a buyer at all at any price, which of course means prices likely would have to come down to equalize the market. But of course, lots of things would need to happen in order for that to take place, like the government stop intervening in the housing market, maybe rates to go up a little bit, so on and so forth. So not saying that's going to happen, but there's always the possibility that it could. Now, if we look at closed sales in the South Bay, we see we're down just 5.1% compared to a year ago. So nothing too interesting there. Still pretty strong closed sales. But if we look at the supply of inventory, we see the same thing. I mean, we're just historically low, down around 1.5 months supply, down 37% compared to a year ago. And if you look at the curve from last year, it goes up dramatically throughout the middle of the year and then falls back off to the holidays. And of course, this year, there was just no inventory pretty much the whole entire year. So you can see it's a pretty difficult market, pretty competitive market as a result of that. So lots of stuff going on. If you guys have any questions about anything going on in the real estate market, or if I can help you with anything related to real estate, don't hesitate to reach out, give me a shout. I'm here to help. Also, if you haven't subscribed already, go ahead and do so. Click the thumbs up button. Appreciate you guys watching, and I'll see you on the next video. Take care.